Welcome to the PAI Morning Briefing. I'm your host from PantheonAI, and today is February 14th, 2025. It's a day filled with insights, a dash of humor, a sprinkle of expert predictions, and enough market chatter to keep even the most seasoned investors on their toes. So grab your favorite morning beverage, settle in, and let's dive into today's detailed rundown.
Let's start with a quick market overview. The S&P 500 index is trading around 6,120, showing an almost negligible uptick of roughly 0.088%. Meanwhile, the Dow Jones is hanging in there at about 44,714, though trailing just slightly with a decline close to 0.0136%. Not too far behind, the Nasdaq is hovering near 19,944, reflecting a modest dip of approximately 0.062%. Meanwhile, the Russell 2000 is performing a bit better, climbing at a more notable rate with a rise of roughly 0.766% and finding its footing around 2,282.
In the realm of digital assets, Bitcoin is priced near 97,117 with a healthy increase of about 0.516%, while Ethereum is not far behind at roughly 2,708, climbing by approximately 1.190%. It's an interesting mix with traditional equity markets showing restrained movement, while the cryptocurrency space is experiencing a subtle yet steady uplift.
Now let's dig a bit deeper into broader market trends. One prevailing theme today is the market's cautious optimism. Investors appear to be weighing the pros and cons of robust data releases against occasional surprises from the real economy, which is hardly ever black and white. We're seeing a blend of moderate wins and slight setbacks. The upward movement in the Russell 2000 indicates that smaller and mid-cap stocks are enjoying relative strength compared to their large-cap counterparts. This divergence could be signaling that while large institutions and tech giants remain focused on their long-term positions, there is an opportunity brewing in sectors where nimble, smaller companies have a flexibility to innovate and grow.
In the world of digital assets, Bitcoin and Ethereum's gains suggest a simmering confidence in the crypto sector, despite the usual volatility. In many ways, these cryptos are still in their don't drop your ice cream phase, where investors hope the price doesn't tip over too much, but are encouraged by steady, albeit small, advances. It poses interesting questions regarding risk appetite. Are investors beginning to see crypto as a mainstream asset class, or is this merely a temporary reprieve from the broader market's caution?
Now let's shift gears as we dive into today's top headline stories that are rippling through the financial and economic landscape.
Our first story centers on retail sales in January. Retail sales slumped by approximately 0.9%, a figure that took everyone by surprise. What's even more intriguing is that excluding autos, prices fell by about 0.4%, deviating significantly from the previously consensus expectation of a 0.3% uptick. Clearly, consumer spending appears to be in a bit of a slump, prompting concerns about the underlying momentum of the domestic economy. Investors must ask themselves, are we witnessing the early signs of a slowdown in consumer confidence, or is this an ephemeral blip in a much larger narrative?
Next up, we turn our attention to industrial production. The headline here states that U.S. industrial production for January increased by 0.5%, edging out the initial estimate of 0.3%. It's interesting when such data not only matches but exceeds expectations. This uptick adds layers to the debate about whether economic recovery is steady but slow, or if we may be on the precipice of a revived manufacturing surge. Background data further illuminates this narrative. Previous months saw revisions that trimmed down earlier growth percentages in industrial production, capacity utilization, and manufacturing output. What this suggests is a recalibration in reporting and possibly in the underlying dynamics of demand and supply.
In energy news, oil prices appear to be on track for a weekly gain, a welcome reprieve for energy investors who have endured 3 consecutive weeks of losses. The resurgence in oil futures came on the back of tariff fears easing up after President Trump did not immediately impose reciprocal tariffs on U.S. trading partners. As tensions ease in this area, the resulting relief is translating into a supportive backdrop for energy prices. The situation raises an intriguing question. As geopolitical risks wane in one area, will there be other dark clouds on the horizon, or is this a sign that global trade tensions are genuinely cooling off?
Shifting our focus to global equities, the European stock market is showing an interesting dichotomy. Despite persistent tariff fears that have rattled markets in the past, European equities have managed to outperform their Wall Street counterparts this year. Analysts at UBS are pointing to meager valuations combined with robust underlying factors as the driving force behind this rally. The factors cited include lower price-to-earnings ratios and a potentially untapped memory of investor confidence that could propel European stocks further. For savvy investors, this performance invites a question. In a market where risk and reward are in constant flux, how should you position yourself between European and American equities?
In another striking piece from the hedge fund world, Ray Dalio's Bridgewater Associates has made headlines by placing a new bet on Tesla. The firm appears to have exited positions in memory chip manufacturer Micron Technology and banking giant Goldman Sachs, redirecting capital into the electric vehicle space. This move invites discussion on both the long-term viability of renewable energy investments and the disruptive potential of EV markets. Tesla, long a touchstone for investors with a high tolerance for volatility, might now be seen as a bargain by one of the market's heavyweight institutions. The strategic pivot of such a renowned fund certainly adds another layer of validation to the belief that future growth will likely be driven by disruptive technologies and industries.
Turning to the tech and commerce sphere, we have a story involving Resolve AI. The company has made a significant move by acquiring Group Revi, a platform that reportedly drives over $30 billion in annual sales. This acquisition, valued at approximately $55 million in an all-equity transaction, aims to strengthen Resolve AI's position in AI-powered commerce. The move is an affirmation of the growing importance of artificial intelligence in everyday business and retail environments. With data-driven strategies reshaping the competitive landscape, it poses an important thought. Are we ready to see AI become as integral a member of the boardroom as any seasoned executive?
Meanwhile, in the pharmaceutical sector, Moderna is working hard to mend its reputation following a quarterly loss. While their COVID-19 vaccine sales have outpaced consensus estimates, the rollout and performance of their RSV vaccine sales remain modest. This situation reflects the inherent challenges that come with diversifying a pipeline that's in a state of evolution. The lesson here for investors might be cautionary. Even behemoths in the biotech space must continuously innovate and diversify. It also raises the question, how will the pharmaceutical giants recalibrate their strategies to avoid being caught off guard by sudden market shifts?
Another acquisition making rounds is that of Core Mining, which has recently completed its acquisition of Silvercrest Metals. This strategic move is a testament to the ongoing consolidation trend within the mining sector, where companies are seeking scale and competitive strength amid fluctuating commodity prices. For industry observers, it offers an additional angle on how traditional resources sectors are adapting to a market that's more fluid and uncertain than ever.
In the realm of artificial intelligence news, Google's AI chief recently addressed the company's workforce, confidently stating that they have all the ingredients to maintain their lead over a notable Chinese competitor, DeepSeek. This assertion came during an all-hands meeting in Paris, where the emphasis was on how Google is in a strong position due to its technological advantages and research investments. It's a bold claim that, if validated, will steer how investors view the long-term competitive dynamics in the technology sector. Yet, one can't help but wonder, when it comes to AI, are we too often caught in a race where the lead might change hands as quickly as technology itself evolves?
Rounding off our list of studies today is a more technical piece regarding U.S. Treasury yields. Yields have felt mostly steady ahead of the new retail sale data release, succeeding in recovering somewhat from a sharp drop experienced recently. The steadiness of these yields indicates that fixed income investors are cautiously optimistic despite fluctuations in other areas of the market. It serves as a reminder that, in times of mixed economic signals, there's a segment of the market that remains anchored by the promise of relative safety. It begs the question, as investors juggle risk across various asset classes, how do fixed income strategies interplay with the overall market sentiment?
That's quite a broad spectrum of headlines and stories, all interlocking to paint a picture of markets that are both dynamic and delicately balanced. Now let's pivot to a detailed sector analysis that takes a closer look at the technology, energy, and finance sectors, which are not only experiencing their own unique pressures, but are also pivotal in determining the broader market trajectory.
Starting with technology, this remains the hat-trick champion of our modern economy. However, it's not without its idiosyncrasies. The buzz around Google's AI and Resolve AI's acquisition of Group N illustrates that there is plenty of innovation, but also the inherent risk of the sector's volatility. When you factor in the competitive pressures from international players like China's DeepSeek, you get a sense of how the technological playfield is constantly evolving. It's an area where you might simultaneously see enormous media hype, bold predictions, and very measured outcomes. In a way, it's reminiscent of the classic tortoise and the hare narrative. The innovations sprint ahead, but the sustainable pace of technology adoption often mirrors that steady, incremental journey. So viewers, what would you bet on a spectacular overnight breakthrough or a gradual buildup that could take years to fully materialize?
Moving over to the energy sector, the revival of oil futures after a dismal stretch of 3 weeks is something that certainly captured my attention today. The easing of tariff fears has provided a bit of relief to what has been a turbulent market. Energy investors are no strangers to volatility, and the cyclical nature of commodity prices means that a period of recovery, even if modest, can reinvigorate market sentiment widely. When we talk about oil, we're not just discussing barrels and pricing, we're discussing geopolitics, global demand, and shifts in energy consumption patterns influenced by advancements in renewable technologies. This interplay between traditional fossil fuels and new energy paradigms is really where the debate heats up. It's a bit like a family dinner conversation where everyone has an opinion, but no one can quite agree on the dessert choice.
That is, do we stick with the tried and true, or do we venture into the less-known territory of renewables? As investors, decisions in this space come with layers of risk, reward, and sometimes an ironic twisty fate when the unexpected happens.
On the finance front, the slight movements in our major indexes, along with the steadiness of Treasury yields, suggests that monetary policy and investor sentiment are in a delicate balancing act. There's an undercurrent of caution, perhaps reflecting the broader sentiment in global markets, yet there is also room for opportunistic plays. With retail sales and industrial production data sending mixed signals, banks and financial institutions will be keeping a very close eye on consumer behavior and corporate performance. It's almost as if the market is performing a high-wire balancing act, with nothing but finely tuned risk management practices as its safety net. And if you're thinking about your portfolio, this is a reminder to assess where your risks lie from equities to fixed income and beyond.
Now let's step into the global market implications. One overarching theme we're witnessing is the interconnectedness of these markets. A decision made in the boardrooms of high finance in New York reverberates from London to Tokyo and even back to smaller, nimble markets in Europe. The performance of European stocks, buoyed by meager valuations and supplemented by a renewed investor confidence, stands as a testament to this interconnected thread. As trade tensions ease and investors recalibrate their positions based on economic data from Washington, we see a domino effect unfolding, where shifts in one region lead to realignments across borders.
For those listening, think about the following. How might the easing of tariff fears in the U.S. influence consumer behavior in Europe? Is the growing influence of artificial intelligence in commerce and technology going to force traditional industries to radically reevaluate their competitive strategies? And perhaps more importantly, how prepared are you to switch gears if the market takes an unexpected turn any day?
Adding a layer of expert insights and predictions here. Many industry experts are leaning towards the possibility that the consumer slowdown seen in retail sales may be just a temporary hiccup. They expect that improved industrial production figures and steady gains in sectors like technology and energy might offset some of that consumer fatigue. There's also a confident voice among tech insiders suggesting that we're on the brink of a paradigm shift as artificial intelligence becomes increasingly embedded in our daily operational frameworks. For instance, Google's reaffirmation of its AI lead not only boosts its stock in the short run, but also lays a stable foundation for long-term growth as AI gradually weaves itself into every fabric of modern business strategy.
Expert analysts are also keeping a close eye on the implications of large-scale strategic shifts, like Bridgewater's bet on Tesla. It's a clear signal that even the most established institutional players aren't content to rest on their laurels. They are actively seeking the next big disruption. When a giant like Bridgewater reallocates significant capital to an electric vehicle company, it sends waves of confidence through the market, suggesting that traditional industries might soon experience a tectonic realignment.
Sometimes I like to think of these market moves as a giant game of chess. Each headline story is a move by one side or the other, and it's our job to figure out not only what the next move might be, but also what hidden strategies could be lurking just beyond our current view. It makes me smile to picture Wall Street executives as grandmasters, carefully plotting every move, while a few unruly market participants are just trying to maintain their balance on the board. It's all very intricate, and the stakes are high.
As we move further into our discussion, let's set aside the macroeconomic survey and take a closer look at a few of the detailed stories we've mentioned earlier. Each of these not only affects a particular sector, but also provides insights into where we might see future volatility or growth.
Taking another look at retail sales, the unexpected slump in January raises some flags. It's not just about the numbers, it's about what these numbers imply for the broader economy. The significant drop in retail activity, especially when contrasted with earlier periods of robust consumer spending, suggests that perhaps households are tightening their belts once again. This could be a reaction to rising prices in certain sectors, higher interest rates, or simply a reflection of cautious optimism. The feedback loop here is critical. Lower retail sales can reduce corporate earnings, which can in turn be factored into stock prices, affecting everything from retirement portfolios to institutional investment strategies. For those of you keeping a close eye on the consumer discretionary sector, these numbers are a reminder to remain vigilant.
Then there's the industrial production data. An uptick, even if minor, acts as a counterbalance to the retail slowdown. It suggests that while consumers may be holding back, manufacturers are still finding ways to optimize production and perhaps even innovate within constrained margins. This dual narrative, a consumer cautiousness paired with manufacturing resilience, could imply that businesses are adapting to a new normal where efficiency and cost management take center stage. One wonders whether this will translate into longer-term shifts in corporate strategies or if it's merely a temporary adjustment period as the market finds its equilibrium.
In energy, the narrative of tariff fears fading and oil prices climbing is a fascinating counterpoint to what many may have expected amid global uncertainties. For years, energy markets have been on edge, with tariffs often serving as a major destabilizing factor. But here we see a reprieve, a moment where markets react positively to a less politicized environment, valuing stability over the unpredictability of international trade disputes. It's a welcome change, especially for investors who feel that energy markets should be allowed to follow their natural cycles without being unduly influenced by policy fluctuations. It prompts the investor and all of us to contemplate, when will we see these policy uncertainties dispelled long enough for a more predictable energy market cycle?
Now consider Ray Dalio's Bridgewater's new bet on Tesla, which in itself is a fascinating move in this intricate game of investments. Dalio, known for his macroeconomic foresight, appears to have realigned his firm's strategy based on the conviction that the future lies in disruptive technology, in this case, electric vehicles. When one of the world's largest hedge funds pivots away from traditional stalwarts like memory chip manufacturers and renowned banks, it sends a clear message. It suggests that the era of incremental growth may be waning, and we are entering a period where bold moves, aligning with long-term technological disruption, are rewarded. For those wondering whether this is a sign to adjust your portfolio, consider this. Sometimes it's worth asking yourself if you're holding on to legacy investments out of habit rather than strategy.
The acquisition of Group by Resolve AI is another story worth a closer look. At a $55 million enterprise value, this all-equity deal is strategically designed to bolster Resolve AI's foothold in the burgeoning field of AI commerce. When you think about it, this move brings to mind the transformative power that technology wields over traditional business models. By integrating a high-growth, revenue-generating business, Resolve AI is essentially laying down a marker that the future of commerce will be defined by data, analytics, and the machine learning algorithms that underpin them. For investors in the tech space, this kind of acquisition is both a signal of maturation and an invitation to look beyond immediate financial metrics and consider the broader transformational opportunities ahead.
On the biotech front, Moderna's situation is a bit of a cautionary tale. Their quarterly loss, despite COVID-19 vaccine sales surpassing expectations, highlights the uncertainties that even industry leaders can face. It's a reminder that a well-known brand is not immune to market pressures. With RSV vaccine sales remaining modest, the company is now tasked with finding ways to restore confidence and prove that it can diversify its revenue streams. It's a fine line to tread, especially in a sector where innovation and consumer trust are both paramount. For investors, the lesson might be to always keep a keen eye on the pipeline, not just in biotech, but in any sector where a single product can dramatically influence the bottom line.
Kerr Mining's acquisition of Silvercrest Metals adds another interesting dimension to our discussion. This consolidation in the mining space speaks to a wider trend in resource industries where scale can be the difference between surviving market downturns and thriving during periods of volatility. With commodity prices subject to rapid changes due to both supply disruptions and global economic cycles, strategic mergers and acquisitions become crucial. In effect, Kerr Mining appears to be positioning itself to weather future storms and capitalize on any upward movement in mineral and metal prices. For those of you with exposure to natural resources, this is a story that reinforces the importance of consolidation as a hedge against market instability.
And then there's the intriguing news from Google's AI camp. when Demis Hassabis, the CEO of Google DeepMind, confidently asserts that the company possesses all the ingredients to maintain its lead over competitors like China's DeepSeek. It's not just a morale booster for the company, but a strategic call to investors everywhere. The tech giant is clearly doubling down on its commitment to secure and advance its technological advantages in a field that is marked by rapid innovation and equally rapid obsolescence. Investors should take note that in sectors where the pace of change is measured in months rather than years, staying ahead of the curve is paramount. But it's also a risky proposition that warrants cautious optimism and regular reevaluation.
Lastly, as we take a moment to appreciate our mixed yet resilient market dynamics, the steadiness of U.S. Treasury yields remains a quiet testament to investor demand for stability. Despite some fluctuations, yields are holding relatively steady as the market anticipates fresh retail sales data. This steadiness provides a counterbalance to the volatility observed in other market segments, reminding us that in periods of uncertainty, certain segments of the market can serve as safe harbors. For those who are diversifying their portfolios, this is a timely reminder that sometimes the most understated asset classes provide the functionality needed to stabilize overall returns.
Now, stepping back to look at the forest rather than just the trees, what are the broader implications of these developments? Markets today are intricately interwoven. Each headline is a thread in the tapestry of global finance. The retail sector's slowdown might prompt investors to scrutinize discretionary spending more closely, while the slight gains in industrial production could signal a rebound for the manufacturing sector. Likewise, shifting dynamics in energy and technology indicate that sectors once considered mature or stable are undergoing their own transformations, each influenced by both domestic policies and global events.
On the global stage, the interplay between American consumer data and European market performance is particularly fascinating. European stocks' strong performance, buoyed by attractive valuations and a cautious yet positive outlook from institutional investors, might encourage U.S. investors to rethink their allocations across borders. It's a dynamic interplay forcing thoughtful investors to ask, are diversification strategies of yesteryear robust enough to counter cross-border sensitivities in today's financial climate? And how might global trade policies or even shifts in geopolitical moods further complicate these dynamics?
Expert insights suggest that while current market conditions might not warrant drastic portfolio overhauls, maintaining a nimble and adaptive strategy is crucial in such an environment. There's growing consensus among market strategists that the near-term future will likely be dominated by sectors where technology and innovation drive earnings growth, even if traditional sectors like energy and finance provide the necessary backbone for stability. It's this balancing act that defines the modern investment landscape, a blend of bold, visionary plays in high-growth sectors, firmly anchored by the tried-and-true sectors that have weathered many storms before.
I have to say, sometimes I can't help but chuckle at how unpredictable the market can be. One moment, you're riding high on optimism when a hedge fund makes a daring bet on an electric vehicle company, and the next moment you're contemplating if the drop in retail sales signals the end of fiscal exuberance. It's like the market is trying to keep us on our toes, reminding us that every day brings a new twist in the narrative. And isn't that a bit like life? A mix of surprises, calculated risks, occasional humor, and the need to adapt continuously.
Before we wrap up, let's pose a few thought-provoking questions for our listeners. What do you think about the current consumer spending trends, and do you see this as a short-term dip or a sign of more structural changes to come? With industrial production showing resilience amid retail challenges, is our economy on the verge of a manufacturing renaissance, or are we witnessing isolated data points with little long-term impact? And in tech, as players like Google and Resolve AI double down on their AI and commerce strategies, can we expect these bold moves to fundamentally reshape the competitive landscape in ways that ripple across all sectors?
For those tuned in from overseas, consider how these developments might influence your regional markets. How will the subtle shifts in U.S. Treasury yields and the interplay between American consumer data and European valuations affect global capital flows? And for everyone, what role do you think artificial intelligence will ultimately play in leveling the playing field between established giants and nimble newcomers in every industry?
As we draw our conversation to a close, let's summarize the key takeaways from today's briefing. First, the overall market is rocked by a delicate balance. Traditional indexes like the S&P 500, Dow Jones, and Nasdaq are showing only modest moves, while smaller caps like the Russell 2000 offer slightly brighter prospects. Second, data on retail sales and industrial production paint a nuanced picture, perhaps a cautionary tale of consumer hesitancy counterbalanced by resilient manufacturing. Third, energy markets are finding relief from tariff fears, setting the stage for a rebound in oil prices at a time when global economic signals remain mixed. Fourth, strategic moves by industry giants, whether it's Bridgewater's renewed bet on Tesla or Resolve AI's acquisition to bolster AI commerce, underline a broader trend of aligning with emerging technologies. And finally, the steady hand seen in U.S.
Treasury yields reminds us that in an environment of uncertainty, some assets remain the anchors that ground our investment strategies.
At PantheonAI, we're proud to be your information co-pilot, guiding you through the twists and turns of an ever-evolving market landscape. Whether you're an investor, a trader, or simply someone who loves to stay informed, I hope you found today's conversation both enlightening and engaging.
As always, feel free to send in your questions at any time. Don't hesitate to reach out to our AI co-pilot if you need further insights or want to dive deeper into any specific topic. Remember, learning shouldn't feel like a full-time job. And with that, I invite you to reflect on these questions and think about how these dynamic market signals might shape your next move.
I look forward to our conversation tomorrow, so be sure to come back for the next episode. Until then, keep questioning, keep investing, and most importantly, keep your sense of humor intact in the face of market unpredictability. Thanks for joining me today, and have a wonderful day ahead.